Welcome to Bowls on the Table, where it's time to eat with financial fundamentals. I'm your host, Chef Earl Pearl at DBCHEFTV. Make sure to like and share this video. Also, subscribe to the channel so when I release new videos, you never miss a meal. Today, we have a very phenomenal show and a very phenomenal guest today. So what we're going to do is we're going to jump right into the Bowls board. And today's financial fundamentals will be Trump 50-year mortgage and minority home ownership. To help us break down, understand, and get a better perspective on these two topics, we have Casey Hayes, a king of approvals, mortgage broker, who we are going to bring to the show and help us understand these things a little bit more. So let's bring in Casey Hayes. Casey, welcome to the show. Thank you for being here today. How are you?
Oh, wonderful, man. How you doing?
You know, it's a beautiful day, and it's always a good time to educate ourselves and with these financial fundamentals and learn what's going on out here to get a better grip on things when we're trying to make progress in this financial world. So thank you once again for coming to help us understand some of these things. I have a few questions for you, and we're just going to go ahead and jump right into our first question.
Okay. All right.
Our first question today is what exactly is a 50-year mortgage, and why do you think it's being proposed?
Okay. Well, first and foremost, the 50-year mortgage is very similar to a regular FHA 30-year mortgage, except it now, adds basically 20 years of repayment time to the to a traditional loan. It what it does is it lowers your payment amount per month. And they basically introduced it because right now, with the rates and the cost of homes right now, it's outpacing what it takes for someone to actually like income. People aren't making as much money as they, the growth of what people are making as far as getting raises and so forth is being outpaced by the interest rates and the pricing of housing. So they proposed this 50-year mortgage to stretch those payments out longer so that it'll lower the payments each month, therefore lowering the debt to income ratio.
Okay. Debt to income ratio, real quick. Can you just explain to people what that is, just really quick? The debt to income ratio. I noticed that that was something. Well, when I was trying to acquire my home, and I had contacted you. Thank you for that as well.
Oh, my pleasure, man.
You actually gave me some very excellent advice that I took, and the debt to income. One of the things that we discussed was the debt to income ratio with me going in. So can you just explain that just a little bit to our viewers, please?
Sure, sure. Debt to income is one of the three basic components on your credit worthiness. So debt is basically we look at how much money you have obligated to go out, basically based against how much you make per month. It's done on a monthly cycle. So say if you have a car note for $500, we look at your minimum credit card obligation. So if you can owe $1 million on a credit card, but if you're only obligated to pay $200 per month, we look at the $200 per month plus your car note and things that are showing up basically on your credit report. That's your debt. And so, say if you have $700 worth of debt each month, but you make $1,000 a month, that means 70% of your money is obligated toward the debt. So you have a 70% debt to income ratio. And unfortunately, with a debt like that, you don't have any room for a mortgage. So ideally, it's about, depending on the loan product, it's about a 50, anywhere from 43 to 50% debt to income, which is the max. And that includes your mortgage payment. So including whatever your proposed mortgage payment is, say if it's 2000 a month, your car note and your minimum credit card uh, doing your minimum credit card. We look at all that. You should roughly make 4,000, 4,500 or more to afford something where all your total bills equal around 2,000. So we don't count cell phone bills and things of that nature. That's why it's only at 43%. They know you have other obligations, but it's just one of that credit and um, credit income, debt to income ratio, and reserve funds are the four main factors of your credit worthiness when you want to get a mortgage loan.
Thank you. Thank you. Yeah, that definitely cleared it up because I know I was looking at my debt to income ratio and I was like, man, we're gonna have to fix this.
Yeah,
Yeah,
sometimes we have clients. We look at their debt to income. We have them pay off some small credit card bills to take that 40 to 50 or whatever that extra, whatever that balance is that's raising their debt to income too high. So it's something that can be worked upon. And it's like you said, it's sometimes people just if they really want the house, they sell their car, get rid of that car note, and then you just get another car once you get in the home. So it's something that we can work with. I work with clients that are in all stages of their uh, financial career or financial, situation, whether they are first time home buyers. A lot of clients I have think they can't afford a home until I look at everything, and we just shuffle a few things around, give them a little guidance. 3 to 6 months, we have them in the home.
excellent, excellent. Thank you. Um, our second question for you: what are the biggest pros of a 50-year mortgage for home buyers in today's high rate, high price market environment?
Okay, well, some of the pros are it's gonna first and foremost lower your monthly payment. So the same house, if you had a 30-year mortgage, say if you were paying $2,000 a month with a 50-year mortgage, you may be paying $1,400 a month. So that means somebody who was making $40,000 now can afford more house. You can afford a better neighborhood with better schools. So it's going to open up the door when used right. Let me preface it with that. When used right, in my opinion, the 50-year mortgage is a great tool. If it's a tool added to the whole spectrum of different loan products. It's going to be easier to qualify for it because one, you don't have to make as much money for the same house. It's going to open up loans and housings for people who think they could just rent, and people who and without it just couldn't afford a home. Um, and when used right, you have to use it. Nobody's going to nowadays. People don't pay off their homes. I mean, for the most part, they stay in a certain amount of time. It's just everything is. I look at everything in a monthly cycle. Whatever you can do to lower what you have to put out in a monthly cycle is what you want to do. So this is a great tool to get in the home, and what people don't take for granted, don't think about. I know mortgage professionals do. We can always refinance you to a 30-year loan later. Once you get some equity in it, once you may make a little more money, or you clear up some of your other debt, we can refinance you. You might get a better rate, and your payment may go up a little bit, but you'll be in a better situation and you'll leverage more equity. You'll get more equity in your home faster. So it's not an end all be all, but it is a great tool to open up the opportunity, the great American opportunity of home ownership to some people that would not have it because of their current financial situation.
A quick question. One of the points that you made is refinancing from a 50 to a 30. Um, what's what's your opinion on refinancing from a 30 to a 50?
It's in your personal. It's all in what you have going on in your life. Because even though you're on, see, one thing people gotta understand: just because you have a 50-year mortgage, you can always pay it off early. You can always
Right.
pay towards your principal. So me personally, I'd rather have a 50, and if I want to pay it off early, I want to have. If I have the option of paying 1,200 as opposed to 1,700 a month, give me the 1,200 option, and I'll put that extra 500 directly toward the principal. And I'll end up paying that 50-year mortgage off in 25 years anyway, because I have more money going directly to principal. So to me, it's a great tool. You just have to use it right. Don't go getting a 50-year mortgage and still living beyond your means. Then it's not going to help you when it's all said and done. You want to use it as a tool, an opportunity. If you have especially like if you're an entrepreneur or you have certain, like you may have a commission based wages, where you're a real estate agent or you may be a waiter or bartender, where sometimes you have busy seasons. In the slower season, you pay this whatever the 1,200, 1,500, whatever the normal mortgage is, and then when you have times where you're really making money, you can pay a little more. So it's a great tool. You just have to use it right.
Okay. So, great tool, guys. Just have to use it right. Moving to our third question. What are the major cons or risk of a 50-year mortgage that home buyers should understand before considering a 50-year mortgage?
Okay. So the biggest con with the 50-year mortgage is you're paying 20 years additional interest on the same loan. So on a 30-year mortgage, say on a $500,000 house, $500,000, you're already paying on the 30 million on a 30-year mortgage. You're probably paying $600,000 in interest over the life of the loan over 30 years. So that means if you stretch it out, if you actually pay all 50 years mortgage on a $500,000 loan, you may be paying $1 million in interest on top of your $500,000 principal. So it's
Wow.
making more money for the loan companies if you're going to pay it for 50 years. But loans are sold on the secondary market so many times. The loan company may not be around 50 years when it's all the one you started with. So it'll be sold. People make money on the secondary markets and so forth. But that's the main thing. You're going to pay more interest if you stuck with it for 50 years. But if that's all you can afford, and you look at it two ways. If you rent, you're paying 100% interest forever, and you're actually paying for a home. You're just not paying your mortgage. You're paying whoever owns the apartment building or the condo you're renting. You're paying their mortgage. So you could pay 100% interest on a rental property on something you'll never be able to leverage that equity on, or you can get in. It's a great tool. I know we spoke speaking of cons, but you're paying more interest. That's the biggest con, and also it's going to open up the door to a lot of people who initially couldn't afford a home. So they may not be as financially sound. So if they're not educated on how to use this tool, as I mentioned, the right way and use it as a temporary tool, it can come back to harm them if they are living beyond their means outside of that. So, but the biggest and the main con is that you're just paying more interest for the same amount of money that if you had a 15, 20, or 30-year mortgage that you would pay. But like I said, if used right, it's a temporary tool. It's not an end all be all fix.
Okay. It's a temporary tool. Y'all hear that? And you would just be paying more interest. So that's something to consider on the
I'm,
term of the
yeah,
loan.
I'm sure the rates are going to be a little higher because if you get when you get a 15-year mortgage, the rates are better than the 30. So the longer they stretch it out, it's more risk involved. So the rates may be a 0.5% or a percentage point higher than what you would see for a 30-year mortgage. But because you have so much time to pay it, it'll still be cheaper than a 30-year mortgage on a monthly basis.
Oh, that's key. That's key.
That's one thing.
That's
The rates are definitely going to be higher than you would see on the 30-year. So a lot of times when you see people promote 4.9 interest rate, normally that's on a 15-year mortgage. So I have clients that say, oh man, rates, they say they're down to 5.8. But yeah, that's on a person with 800 credit score on a 15-year mortgage that's putting down 30%. That's like the best case scenario. And then everything outside of that gets an eighth of a point, a quarter point added onto to that 5.5 you see. So because
mhm.
you're doing a 30-year mortgage and you have a 680 score, the best we can get you without having to buy it down is a whole point higher because that's where we're starting. So it's a sliding scale, and it's a lot of misinformation out there if you really don't know how to peel back some of the layers of the onion.
Okay. Moving to our fourth question. From your perspective as a mortgage broker, who would benefit from a 50-year mortgage and who should avoid it?
Well, first and foremost, the people that's going to benefit are people in higher priced areas, like the Washington, D.C. area, the New York area, places where houses are just extremely high compared to the average home price in the rest of the country. Because the prices are higher, someone still making a moderate income can afford those homes that they normally wouldn't be able to afford because you have a longer time to pay it. So it brings down that monthly again to your debt to income. It might make us the same house that may sell in Atlanta or sell in North Carolina places for 400,000, they sell for 700,000 in Potomac or in Bowie, Maryland. So you can afford that house. You'll still have a $3,000 a month mortgage on it because you're stretching it out longer. So basically, anybody in areas where where the price point is a little higher, it'll still make those homes affordable, and you can still get your kids in better school districts where you may not have to pay for private school. The local, that's what most home buyers, especially with families, they look for school systems first, places where you might not have to pay, you know, $1,500 a month for private school because you got a mortgage in the school district that's favorable, one of the best in the state, county, what have you. And
Absolutely.
yeah, and to me, it's not ideal for people who have unstable income, like I mentioned before. Um, People who uh, just go from job to job. People you know, uh, who you're not sure because you may bite off more than you can chew. Meaning,
Mhm.
you might be able to. And I'm just saying, people, it's a per case basis. But if someone uh, on a 30-year mortgage, they say you can afford a $400,000 house, and on the 50, we can get you in a 500, $600,000 house. That $400,000 house may be what you actually need right now, and like I said, in your financial situation. So it's just it's it's kind of a per case situation. But if you have fluctuating income and you're not stable, I would kind of stay away from it.
Okay. Job stability. You hear that, y'all? Job stability. You want to make sure that you have that. Um, Either way, 30 or 50. That's what it sounds.
You're absolutely right. And, yeah, any before you purchase anything, you want to have job stability. One of the prerequisites, you have to be working somewhere for 2 years minimum. But we don't, we check
Okay.
you've been there 2 years, but that don't mean you've been working every week for 2 years. As long as you've been, you understand what I mean? So there's
Okay.
some personal accountability at stake too. So, but like I said, on a case to case basis, overall, it's like I said, if the tool is used right, the pros do outweigh the cons, in my personal opinion.
Okay. Okay. Our next question. How can the 50-year mortgage affect housing affordability, supply chain issues, and allow wealth building opportunities?
This is a great question. This is a great question because it will short term, it will boost affordability, right? But long term, because your interest is stretched out over 50 years, your equity will not appreciate as it would on a 30-year or 50-year mortgage. Meaning, most loans are stacked front end. So the first 5 to 10 years of your loan, first 5 years of your loan, 90% of the money you're paying is going toward interest. You're a homeowner. You see what's going to an interest and how much is going towards your principal. After you get to about your 10th year, it's about 50-50. Then more of it start going toward the principal than interest. So by stretching this out over 50 years, it may be 20 years of you paying up to 80% interest only. So of course your equity, of course, your house is going to appreciate at a certain level, but the actual equity of you paying down is at a very, very slower rate. So, from an investment standpoint, and from being able to leverage your equity later on and things like that, that's one of the caveats. That's a caveat. So, for an investor, unless you're going to do a quick flip, get in, have a low rate, and get out of it pretty fast. For long-term equity, it does slow that process down. That's why I say temporary tool. You get in it, you may have to get a second job, whatever you may do. You may get married where you have two incomes, but then you refinance it. You may pay a little more, but your equity will start growing faster. Or you
Okay.
could, like I said before, you could also pay a little extra strictly toward the principal every month and use that route. So if you crunch the numbers, um, you might find a sweet spot where you take advantage of the lower minimum payment that you have to pay, and you may have an extra 500 going toward equity that may outpace what you would do at a 30-year, on a 30-year mortgage. That $500 extra you're paying per month that's going 100% to equity, just that alone, being able to do that may outpace the growth on a 30 years. So I would consult your accountant or someone like that. I can't give accounting advice. I can just give you the pure numbers, what it'll cost. I can give you the uh a scale or so you can see how each payment, how much you owe on principal and so forth. But other than that, I just have to I give you the numbers. You have to make the opinion, you have to make the actual decision I can't give you advice. I can just give you the actual numbers. I can give you my professional opinion. I deal with, like I said, from the investors down to the first time home buyers buying a condo coming straight out of college. So I have investors that buy 2 homes a month. So you know what I mean. So I deal with people on all spectrums of the mortgage scale on residential and commercial side. So I think I have a good grasp on. I'm not. It's not a one sided assessment of what I'm giving.
That's right. Okay. Um, the supply chain issues. I know that in that question we just asked, I know that we see a lot more housings coming to market. People looking to sell, and what are your thoughts on that?
I think it'll create a buyer's market, meaning it'll be a better time for the buyers because it's going to be more people out here buying homes now. So there is well let me rephrase that. It's going to be more people qualified to buy homes.
Okay.
Um, it can go either way. I'm sorry, because it could create a housing shortage because there's more people buying up homes, and then we can have a shortage of what's available out there, and that will in turn into a seller's market. Because if you have 10 people trying to get one house, me as the seller, I'm gonna make you guys compete against each other
Yeah.
because of the shortage. So it could go either way depending on, and I think it's going some loan programs come and go. So it may be something that lasts for 5 years to kind of stimulate, slow things down, balance things out, and then it may go in another direction because there's a lot of corporations that bought up the surplus of homes out here just so they could turn them to rental properties and charge a crazy amount. Like people, there are companies that hedge funds that just buy have bought thousands of new development neighborhoods that was supposed to be for public. They buy them straight cash, and they rent them. But the economy, they weren't expecting some of the things going on now as far as the economy, and they're stuck with them. So once those start liquidating, I think there's going to be an influx of viable, affordable housing throughout the country. So once we have the houses and the qualified people, it'll kind of balance out a little bit.
Okay. Moving to the second part of our conversation today, the second topic, minority home ownership. That leads us to our next question. How does a 50-year mortgage impact minority and first generation home buyers?
Well, as I mentioned again, this temporary tool, I'm gonna keep saying that, is ideal for first-time home buyers and the minority parts of the minority public because we don't have the same legacy and generational wealth that's left behind from a lot of other non-minority home buyers or potential home buyers. Most of them have homes that's been around in their family for years, or the benefits, the financial windfall from people owning homes in the 40s, 50s, 60s, and leveraging that equity over the last 50 years. We were, for the most part, redlined, Jim Crow type of laws while we weren't in that by design, we weren't included in that. It's going to open up this opportunity to people who normally probably couldn't afford a house. So families that we have generations that only lived in apartments. We have generations that lived in the same projects, 4 or 5, aunts, uncles, everybody came through there over the last 40 years. And this will change that narrative. This tool, if used right. My thing is it just has to come with some type of a counseling educational component before you can take advantage of it. That's in my opinion should be mandatory before I could fund this loan. Like there's some down payment programs that before I can get you that, you have to take a 2-hour course on the pros and cons of this particular loan product or this loan tool. And I think this particular loan product has to have that. So you know all the caveats, all the things that look out for. But to answer the question, I think it's a great tool for minorities, definitely first time home buyers. You can get in a home cheaper than ever. You can have that lower rate while you're still in your first, like you may be in your first job out of college, high school, trade school, military, whatever. You can afford a better house, better neighborhood. And then as you grow, as your economic windfall, you get married, you make more money, you move up in your career, you can change, you can restructure the loan, you can refinance it, or you can sell the house and move somewhere else into a different neighborhood, and rinse and repeat. But I think it's a great tool for minorities and first time home buyers.
Absolutely. Our next question: beyond obtaining a home loan, what challenges do you see for minority home buyers? And what are some practical or policy solutions that could increase minority home ownership?
One I just touched on, lack of generational wealth. We're starting this game 200 years behind, 100 years behind financially, not just what we make, just not even including the income gaps, but just the legacy. No, we're not getting left with inheritance and with money, or we don't have parents that can just give us a down payment or gift us certain things that these parents do, or we don't have a home that was given to us that we can leverage equity against to buy our first home. So that's one of the main things. And there's another thing to me that really some people touch on it, but it's something. It's an unspoken. People in the industry understand it. A lot of people try to act like it don't exist, but appraisal bias still stands. It still hurts us because I've had clients that are blatantly in $1 million homes, black clients, especially like in Prince George's County, where I do a lot of deals in, which is one of the most. It was the most affluent black county in the United States for people who don't know, not familiar with the DC area. But I've had clients, affluent clients that um, get the wrong appraiser, and a home that I just refinanced 6 months ago that appraised for literally 1.2 million, 1.1 million, because they come in and it's a black home, they come in $300,000 lower than what it was just appraised at. And like I've had people had to file suit, and we've had people, I don't want to say sting operations, but we've gotten another third party appraisal company another appraisal company come through without the person who actually owns the home there, and they come back and get an appraisal $300,000 or $400,000 higher than what this one appraiser do. So the crazy part, the appraiser that this one instance, it wasn't even a white appraiser that did it. There was a Asian appraiser that came in hundreds of $1,000s lower than what it's worth. And this is something that's rampant. You'll see if you research it, appraisal bias, it's real. It's something that's still happening to this day. And because there's no real oversight, there's no governing body that holds these appraisers accountable. You can file a complaint, but some people, because if it's not a multi-million-dollar home, it may be a 50 or $60,000 difference, and people just think, oh, they just think it's water under the bridge. But it's systematic, and it's unfortunate. We need more black appraisers, and we need more oversight on the whole appraisal process, because it's making people, it's devaluing your home when you may want to sell that to move it to a new home, or leverage that equity to invest in something, or just leverage your equity. The appraisal is what tells you, when it's all said and done, what kind of equity you have in your home. No matter what your principal is, what you owe, whatever that current appraisal value is, when we go to refinance it, that's the end all be all.
That's very interesting. Not to go too deep into that, but I definitely would do some research. But do you think that that's because of that is happening because of the neighborhood around the location of the homes, or it's just you just see it as just a normal bias?
It's a normal bias because like I said, I had one in Prince George's County that was a couple hundred off. That wasn't the one we did the sting on. The one we did the comparison on was in Potomac. Potomac is a 90%, probably 95% white area in Montgomery County. I have a guy, he's a pharmacist, black guy. He owns multiple pharmacies. I spoke to him yesterday. He just bought his fourth pharmacy, and he owns two properties in Potomac. One is an investment property, one is his home. It was This home is like a $3.1 million home. That's what it is appraised at. He bought it, made a great investment, added a pool to it, put a fence around it, and it went up in value almost 800,000 from what he bought it from when he purchased it to when I refinanced it. So after I refinanced it, he's a very savvy guy. He leverages equity in all his homes. So he wants to, if he has 200, 300,000 in equity, he wants to squeeze it out and use it for his next business venture. So we went to refinance it again. They didn't know that we just got it, you know, uh, appraised 6 months prior for 3.1 million, and they came back. I want to say it was like 2.7. It was drastic. I mean, it was hundreds of thousands of dollars cheaper than what it had just got appraised for. And that's what we did.
Wow.
Another appraiser out. We did file complaints against this particular appraiser, but it was the new appraiser came right back after them, and um it appraised at 3.1. But like I mean, it was a drastic difference. We weren't able to get him. We weren't able to do the deal with the amount that they came in with. And of course, he was our rate. They appraised his property against properties outside of his neighborhood, like a mile away, in North Potomac. Like it's still near, but it's not as affluent. So
Right.
definitely wasn't the neighborhood at whatsoever.
Yeah. Yeah, definitely. Well, it seems like you are all over it, and fortunately for that, thank you for bringing that awareness. That's something for people to be mindful of if you live in the communities that are very nice, and and you need to get an appraisal because you're looking to leverage your equity,
Hmm.
or even for tax purposes, because I know that that's something
Yeah,
that is
that's
a
right.
big concern.
It's called appraisal bias, man. You'll hear more about it as people bring light to it, but it's something that needs oversight for sure. We need another thing too. I mean, I wanted to mention a couple barriers. Student loans. We go to college. We get these degrees and so forth, but because again we don't have that generational wealth handed down, we come out of school. And I'm not saying we're the only ones, but we have student loans. I have to count your student loans against your debt to income. So you might be in your first job, you may have 200,000, 80,000, whatever amount of student loans. That that decreases your buying potential. So that's another thing that hurts minorities a lot. And then income gaps. We may have the same come out of college. We may both be going to the same accounting firm, but inherently over the years, that white male may get $25,000 more than I do just because doing the same exact position. So that's real, and that's something that's stacked against it. So we have quite a few things that we have to fight just to get make this American dream possible of home ownership.
Absolutely, absolutely. So moving to our next question: if or when the 50-year mortgage gets implemented, what should be the first time home buyer strategy?
Okay, I'm gonna go back again. Temporary tool. So you have to go into it knowing it's a temporary solution. And those first 2 to 4 years that you're in that house, you're using that, I would put whatever I could extra toward that equity, like going strictly toward my principal. So I'll pay whatever the minimum is that it got me in it. But any dollar I get extra, I'll put toward directly toward my principal. So in 2 to 4 years, I can refinance out of that particular loan and get a better rate, and get a shorter terms. Give me a 30 year. Even if I get another 50 year, the better rate, it's still better than what you initially got just to get in. I'm guessing it's going to probably be 3% down, 3.5% down, like a standard FHA loan. They haven't introduced all the details and parameters of the 50 year, but by being a government backed product, I'm pretty sure it's going to be 3, maybe 1%. Who knows how much down? But I would put it in those first 2 to 4 years. I would make separate payments as much as possible. I don't care if it's $50 a week directly toward the principal to try to leverage as much equity as I can up front so I can refinance it. So, like I said, you just have to use it as a tool, not as an end all be all, get complacent and think you just got a $1,200 mortgage in this house. I would just use it as a temporary tool. 2 to 4 years would be my game plan.
All right. Our next question: what is the overall state of the mortgage industry today, and where do you see it heading over the next few years?
Um, Right now, it's in a great space. You see a lot of misinformation on the news, like the news. You see clickbait, this is that, and these are down and so forth. But you got to remember, on the mortgage side, I mean, on the lending mortgage side, only one part of our business is people buying homes. People buy homes, that goes up and down. But there are millions of homeowners out there that want to leverage equity. So when I refinance your loan, that's a whole new loan for me as well. If I don't refinance your main loan, if I give you a HELOC that you leverage some equity. That's a deal for me. Um, it's very innovative now. I use AI every day to find qualified potential customers and clients. Um, every day I get a new loan product in my inbox. There's thousands and thousands of lenders out there with billions of dollars to give. They want to give the money.
Mhm.
They just find certain niches that they want to get paid back, of course, too. So they sit back brainstorming on coming up with loan products to service segments of the population. I have loans strictly for dentists. I have loans for physicians, for military. I have loans for people who own businesses and write off every single penny. So on paper they don't make money, but I have bank statement loans for them. You don't have. I don't need your taxes. I don't need your income. As long as you have a decent credit amount and you have 12 months bank statements, I can use just the money flowing through your bank account to come up with your income. So there's innovative loan products that's benefiting the general public. You just have to get the information out. And that, like I said, that's one of the reasons I started doing what I do, because once I realized that, man, people like literally don't know they can afford a home. If you're paying 2,000, 2,300, even 17, $1,500 a month renting, you can afford a house and get you some equity and get in a better, get in a better position for your family that you can pass on something or something that can become an investment property later. So um, education is key. Like I said, there's so many loan products using AI, using the technology, and leveraging these lenders against each other. But like I said, I started in retail where I just worked for a bank, basically one lender that had 10 loan products. And if I tried to qualify you, if you didn't work for none of these, if you couldn't fit in none of these baskets, I just had to give you a denial letter. Now I work with so many builders and so forth as their secondary. They may have their primary or premier lender, but as soon as those are turned down, I tell them send them to me. I'll match you up with one of my other lenders with a tailor-made product that I may have three lenders competing. I put your scenario together and I shop it around, and I tell them, "Look, he's ready. I have 7.2 from here, such and such and such. What can you do? It may be a fraction of a percent, but a fraction of a percent over 360 payments, which is the 30 years, equates to 40 or $50,000 over the length of the loan if you stay there. So, I work the system in my client's benefit.
Absolutely. That's wonderful. That's wonderful. Our last question for you today. As a mortgage expert, what advice do you have for the people waiting on the sidelines? Should they buy, wait, or just something different altogether?
I'm gonna tell you like this, man, and this might be one of the most important messages we say. Well, probably top three today. If you're qualified to buy now, buy now. The way the prices, the market is going up, prices, homes, whether slow or fast, they appreciate. So the amount that you may make when you get a raise next year, or you're waiting and so forth, the appreciation is going to outpace what you get. That 2, 3%, whatever you may get, at your job or salary, whatever, unless you just change careers or you add a second job or get married, but you have another income, is going to outpace the appreciation for the home is going to outpace it. The same house that was 400,000 last year is going to be 440, 430 next year. So especially in the neighborhoods you want to move into. So if you're qualified, get it. Don't wait. Buy it. Get you some equity, because if you're not owning right now, people say rates and stuff like that. It's the saying in the business. Date the rate, marry the mortgage. You marry the house. Like if you like a house, you marry to the house. Rates fluctuate and change. You date the rate because it's going to change 2 months from now, 6 months from now, a year from now. When it drops, you refi. Now you're saving money every month, and you can still put that extra money towards your principal. But don't listen to what happens, because back in the 80s, 85, early 90s, interest rates was 12%. People were
Yeah,
buying houses.
yeah, they
Right
were.
now, like people, back in, during the pandemic, rates dropped 2%, 3%. We'll never see it again unless there's another global pandemic. So trust me, we don't want to see 2%, 3% interest rates, because it was a subsidy. It was like a stimulus check by lowering it, because so it was making people still be able to afford the homes they were in, because people were out of work. So if you had a 7, 8% interest rate, and I was able to refinance you to 2%, you're saving $1,000 a month on your mortgage payment. Now you can afford it because you may be on a limited. Your wife might not be out of work. You're still working, so it was a form of a stimulus check. It wasn't just the market fluctuating naturally and the rates dropping to those rates. I have people that have those rates that are married that are just they need to leverage money in their from their homes, but they're scared to do anything because they refinance during those 2021, 2020, during those time frames. And I tell them, okay, you want to get a HELOC, but the HELOC is 11%. So now you got a mortgage of 300,000 or 400,000 for 2.2%, but you got a HELOC for 200,000 at 13%. When you balance those out, you're paying 8-9% anyway. So why don't you just refinance the whole thing? What I mean, I try to tell them from a number standpoint, but some people just want to say I got a 3.9 or 2% rate. Not saying they got a second lien for 13, 11 double digit percentage. They're
Mhm.
paying the same amount for 200,000 that they're paying for the $400,000 mortgage. When
Right.
you could combine them, and you might be paying a couple $100 more for that $200,000 that you're using to pay off whatever you may be doing. So don't fall in love with the rate. Like I said, it's tools. That was a tool that we needed at the time to stimulate the market. People weren't buying homes, and people took advantage of it. And they got it's gone. It may drop again into the fours, high fives, late high fours, low fives. When those come, when it dip, you refinance. But you don't let it. You don't procrastinate. Just sit on the sideline because the game will pass you by, and you'll pay a whole another year of rent. Next, thing you know, you got to renew your lease. Now you're paying 100% interest. Like I tell people, you're crying about a 8% interest rate, but you're paying 100% interest in this apartment. You're paying every penny you go. You're paying is paying for the landlord, whoever owns the building, is going in their pocket. You could be there 10 years and you don't have $1,000 in equity. So you know what I mean? You're not comparing. You're comparing 100% interest rate against whatever it may be. So make the move. Take the leap of faith. Use those tax write-offs. Leverage that equity and leave something for your kids. And you know what I'm saying? Leave something for your family so we can start a generational wealth building situation.
Absolutely. Absolutely. Well, we want to thank you for being our guest today
Oh, thank you guys, man. I
here
appreciate
on Bowls on the Table. You are welcome to come back anytime you want. How can people reach out to you
it.
if
Okay.
they want to utilize your services or
Very,
get more expertise?
very simple, man. I'm a man of the people. I'm a phone call away. My email is info@kingofapprovals.com. info@kingofapprovals.com. And my direct number is 301-379-0563. I'm a phone call away. No, there's no stupid questions. You may have a loan that you're about to close on. I probably can, not probably, I can beat it. Like I have enough loan products. I can confidently say, you send me a loan estimate, I can beat it. I can save you some money. So reach out to me. If you just need another set of eyes to look at something that you're contemplating, I'm a phone call away. Utilize these services, man. Utilize it. This is why I'm here. Of course, I'm compensated handsomely for what I do, but I'm not doing it just for that. I love helping people, and I love the joy of being called somebody and say, you're approved. You're pre-approved for this, and I can get you in this house.
Absolutely. Casey Hayes, King of Approvals. Thank you for joining us today. All his contact information will be in the description. So you guys can just go into the description. His email and contact number, info@kingofapprovals.com. And the number will be in the description. Once again, thank you for joining us. We want all of our viewers to have a peaceful, positive, and productive day. And remember, it's always time to eat right here with Financial Fundamentals on Bowls on the Table. We will see you all next episode.
This whole publication is all about going from nowhere to somewhere, right? Being able to stand on something so that you can travel in peace, right? So bksofarm.com, 1016 160 self-sustainability. Jump on the list and get yourself together, right? Because it is irresponsible to not even know what responsibility means. So get yourself together, food, clothing, and shelter, protection of that, support your interests, and live.
Some say that art imitates life. but we say that light is art. So visit the DBCHEFTV gift shop and get 15% off of your next masterpiece of fashion. How do you get there? Simply tap the link in the description. At the Veteran Kettle Podcast, we thank you for your service, support, and sacrifice to our country. Listen to real stories of adversity and triumph as we give our best to honor our vets. Subscribe today and watch episodes now streaming on YouTube at TVK Podcast, The Veteran Kettle. If it's Friday night and you don't have a date, then brunch with the fellas is your spot, so don't be late. We go up at 9 p.m. with the trending topic news. Smash the like, comment, subscribe, and share the content. Don't be rude. At Brunch Fellas, now streaming on YouTube. Love ain't always easy, and we won't stop until we get it right. So bring that ass to the Love Speak Podcast. Subscribe today and let your love speak at TLS Podcast, The Love Speak, now streaming on YouTube. Exchange insights Sundays at 8 p.m. East Coast time with the Cigar Panel, smoking on words like two big nerds, hosted by DBCHEFTV and BK Soul Farm at Cigar Sundays on YouTube. Subscribe and hit the notification bell so when they go live, you never miss an episode of Cigar Sundays Live. Sign up for the newsletter and shop merch and clothing at www.dbcheftv.com.